Hello out there, and welcome to this webinar of NowcastIQ. My name is Mikkel Rosenvold. I'm joined today by my usual partner, Andreas Steno, and we are very happy to see so many of you join this little webinar and presentation of NowcastIQ. We might have a few joining us over the next few minutes, so we will get started a little bit slowly. If I'm looking to the side here, it's because I'm just watching people join the show, and I'm also watching the Q&A page, which will be open throughout the show. So if you have questions, please leave them in the Q&A section, and we will get to them. It should be anonymous, so you shouldn't fear having your name posted everywhere. So don't worry about that. Obviously, you can always get back to us with questions after the show as well. You're more than welcome to that, and we can pick that up. We have a great number of participants already, so that is really, really great. Thanks to all of you for joining us. We know we have a wide range of viewers today. Some of you may already be users of NowcastIQ. Some of you might be following Andreas and my research on other platforms such as Real Vision, or perhaps you're former clients of Steno Research, or perhaps you're just entirely new and interested in this nowcasting space. So no matter which category you're from, we're very, very happy to host you today and happy to showcase our little gem of a tool that we have here. So most of you will probably know who Andreas and probably also myself is. If you don't, then Andreas and myself are macro geopolitical analysts. We've been running our own research company for a few years. We split that up during the summer of last year. Some of the retail parts, so to speak, went to Real Vision. We are covering that with articles, but we kept the institutional and data part with NowcastIQ. We realized that we had built a couple of really, really great nowcasting tools. We were using them extensively, both for our own money managed and for research purposes and analysis purposes, but we had never really succeeded in making them useful for anyone besides ourselves. That's not really Andreas and my strong suit, so we teamed up with a great team at Leopard Labs, and together with them we created the platform that we're now calling NowcastIQ. So the entire idea about NowcastIQ is to provide you with real-time gauges of the macro world. We're going to dive much more into the drivers, the regimes, and the trade indicators that we're providing you with, and finally, we're also going to talk a little bit about the platform and some new options for both pricing and trial that we are opening up. We are very, very happy to hear your thoughts as well. It doesn't have to be questions. If you just have some reactions to what is useful and what is less useful, that's also very, very helpful for us, obviously, as we're trying to build this product. So without further ado, I will be hopping to the screen share. I think I already have it up and running, and I will be logging into NowcastIQ. For those of you familiar with Andreas's macro research, you will know about the macro regimes, and we will be talking much more about them today. Obviously, the catalyst or the timing for this webinar was that we've entered a new macro regime, the regime of gung ho. That is very much the core of what we try to present on NowcastIQ. So we will be getting much more into that. First of all, I'm just going to give you a very brief overview of what is in or what is on the platform, because that will make it a little bit more sense as we click around a little later. So now I have logged into the overall dashboard of NowcastIQ. In the top, you have the option of choosing between various geographies. We're going to keep it simple and stick it to the worldwide model for now. You have a brief overview of what you need to know about macro right now. And then you have the drivers, the regimes, and the trade sentiments. We will explain the dynamics between these as we go forward, but essentially the drivers are the three key macro drivers of growth, inflation, and the liquidity. They are translated into a macro regime, and then we use pattern recognition to gauge or to predict the best positions within that macro regime. You're also able further down the page both to access some of our research depending on the tier, and you're also able to look backwards in history and seeing heat maps, seeing distributions, probabilities of the various regimes and indicators. We also have a sub-page for our macro portfolio. I'll be going to that a little bit later as we dive more into the options here at NowcastIQ. So now I'm going to hand over the baton to you, Andreas, because we have been talking about doing this Nowcast IQ webinar for some weeks, and we thought this was a good timing because we have a regime change. So maybe we should start there, Andreas. What does it mean that we have a regime change, and what has changed?
Well, as you can see from the screen share right now, we're currently in a so-called gung-ho regime, meaning that inflation is most likely falling, growth is most likely reaccelerating, and liquidity is increasing. That's kind of the cocktail we have right now. And in sharp contrast to what we had towards the end of last year and the early innings of this year, the biggest change of scenery is the reacceleration that we've seen in the growth parameter. So we've basically gone from a scenario where growth declined in cyclical terms to a scenario where growth started picking up, especially over the past couple of weeks. And that is, of course, a game changer for the excess growth, especially for the US. That is currently, we see a very strong reacceleration of the cyclical growth picture in the US. And it's very interesting that we see this reacceleration alongside inflation that still behaves. Typically you would expect inflation to follow the macro cycle, but right now we're seeing a reacceleration of the growth outlook without a reacceleration of the price outlook. And therefore, this is an interesting cocktail given that there's positivity around the growth cycle, and at the same time, you don't have that second-hand or second-order effect on inflation yet, at least, making this a very upbeat macro environment overall, especially compared to what we saw towards the end of last year in the US. Having said that, Mikkel, it may make sense to give a bit of context on how we actually measure these things, right? Because if you look at inflation, growth, and liquidity on the left-hand side here, we're measuring these things in probabilities. And why do we do that? I mean, we could, of course, also show that inflation is, say, 2% right now. But instead, we prefer to show it as a probability. And the reason why we do that is that, for each nowcast, we express this as a probability relative to the most recent official data that we've received. So take the example of inflation. And nowcast currently at, say, 20%-ish means that there's a 20% probability of inflation being higher than the most recent officially printed number. And why do we prefer to express it as a probability? Well, most portfolio managers, our portfolio, etc., they prefer to view the world through the lens of probabilities because we don't have perfect certainty around anything in economics, but we like good odds, right? So when there's a 90% probability of something happening versus something that not necessarily appreciated by the market yet, then the risk reward starts skewing in your favor. And that's essentially why we look at it in probability terms rather than in nominal terms, because the interesting thing is basically whether there's a high probability of being right or wrong.
And so, Andreas, let's maybe dive a little bit more into what goes into the three parameters here. Maybe starting with inflation, because this is not merely a data from the official sources. This is our own nowcasting. Could you just put a few words to what goes into that?
Yeah, so we've basically built this inflation indicator from a bottom-up perspective, meaning that we're trying to explain individual price categories, and then we aggregate them as we go along. We use both market-based data and proprietary price data that we find online. And when you look at market-based data, we're talking about things that are traded on an exchange. Some prices are readily available on an exchange, right? Food prices, to some extent, energy prices, etc., freight prices. But then we also collect online data directly from retailers, platforms, etc., on everything from housing to services, etc. One example could be that we use Momondo to track global travel prices. One example could be that we use electronics prices from MediaMarkt in Germany specifically for that market, right? So we've pinpointed the relevant retailers in each of the markets, and we get some price points from each geography. For what we do in each subcategory on inflation is that we collect this set piece of price observations, and then we run historical regressions against the official sub-index of the Statistical Bureau to ensure that we're able to explain between friends roughly 80% or more of the historical variation of the official inflation number. You see other data aggregators just showing their data aggregation live. What we try to do is to match our data aggregation with the official numbers because we want to explain the official numbers. And for each subcategory, we then run regressions and we try to get to the official number once it's released. And this should hopefully provide you with, say, 3, 4, 5 weeks of an edge relative to the official numbers, because obviously, for example, the US inflation report is released a couple of weeks after the calendar turn every month, while we've been collecting the data through the month, the reference month, right? So we actually have some data as it is live that will slowly but surely increase the probability of us being right ahead of the actual release of the number, which hopefully provides you with an edge in terms of predicting price behavior ahead of the official releases.
Yeah, I like to use, and when explaining this, Andreas, an event we had, I think it was about a year ago. I can't remember the timing exactly, but I remember coming into the office one morning and the model had completely collapsed the growth parameter for the US economy because of an extreme outlier in the traffic in and out of Manhattan, which was not due to a complete crash in economic activity, but simply due to new road tolls. Those of you living in New York will know the details of this, but it's that's obviously where you need to turn off the model. We corrected for that, but it's a good way to explain how our model is tracking live data, live events, and translating that into macro numbers. So just a little anecdote for that. Okay, Andreas. So moving along here, we have the probabilities of growth, inflation, and liquidity being higher than the latest print, essentially. That's then translated into one of these macro regimes, which we then also calculate a probability for. So this is always probability gauged. You just explained the shift to gung ho. If I move down here and show you just for the past year, I can show you all of our regimes. We have been mostly in what we for most of 2025, we were in the lame duck QE regime, shifted to the QE-like regime, and then into the gung-ho. And this is interesting because, and I'll let you explain the logic behind this afterwards, that we then use pattern recognition to gauge what are the best traits in this macro regime. So based on previous sightings or instances of the patterns that we're seeing right now, you can flip through the various regimes, and it will show you the expectance of or the sentiment that we provide of these. So right now in the gung-ho regime, we have a very strong sentiment for crude oil. If we switch to the number 2, the QE-like, we see that crude oil is flipped. It's not a very strong signal, but still it's flipped. So it's very, very relevant that you have this switch from QE-like to gung-ho. So could you just put a few words to how we produce these trade sentiments, Andreas?
Yeah, so the purpose of this section on trades is essentially to provide you with empirically backed evidence of what to trade in which regimes. So in the case of the gung-ho regime now, where inflation is going lower, growth is picking up, and liquidity is picking up, you see a strong return profile for oil, for example. So what we do is that we go back in time during the time period where we've actually collected this data, and we look for the most reminiscent periods from a macro perspective. We basically allow a model to look at the entire time series history and find the instances where the macro picture compares the most. And that obviously gives you an empirically backed evidence of what to trade in which regimes. Of course, there are no guarantees that markets will track exactly the macro regime that we're in every time, but it gives you a higher probability of being right in the current regime compared to just eyeballing stuff, right? And I think it's fairly interesting to do it this way because, I mean, even if a macro environment like the current is kind of textbook, right? You see inflation going lower, growth going higher, and liquidity going higher. From a textbook perspective, you should be able to pinpoint roughly which trades to be in,
Mm.
but it's not necessarily the same trades that work empirically, which is very interesting. And by doing it this way, we also avoid the risk of being too early or too late in using our nowcast to predict trade patterns because we essentially allow the empirically backed evidence to decide for us instead of just logically deducting which trade to be in. And occasionally, I'm very surprised by what to trade in various regimes because it doesn't always follow the textbook logic what to trade. So I think this is the right way of doing it. And the reason why we've done this in risk reward terms, maybe you can show the commodity sentiment at the current stage
Mm.
again, Mikkel, is that we want to provide both a gauge of the upside and the downside and provide the ratio of the two. Because again, that's the relevant metric if you're a risk taker. Uh, of course, one thing is to know the base case, but you also want to know the upside versus the downside for the trade. And that's why we have it as a ratio where a 10x is basically, almost as good as it gets, right? The upside is roughly 10x of the downside that we've observed in this regime. While if you get very close to zero, it means that there's almost endless downside compared to upside
Mm.
in the ratio. So that's how you should view these ratios for each of the assets. And again, I think it's the right way of doing it because you empirically test your thesis this way instead of just logically deducting what to trade in an environment.
So maybe, Andreas, we could be a little bit more anecdotal, and we can pull up some of the historic data here. I'm just going to flip to my presentation here.
Mm,
So this is the regime model for the US. Maybe we could go a little bit more anecdotally because we've been managing money throughout this period. I think most of the
mm,
viewers on this show will know sort of intuitively what happened during 2025. It was quite a year for most investors.
mm,
So obviously, Andreas, we had a very big reversal of trends in growth. Actually, already from January through April, even though we didn't have the tariff scare until April. So how did we use this for managed money? And could you put some anecdotes to where this has been useful and how quickly you have to react to these regime changes?
So a couple of things to note here. If we look at 2025, the interesting thing is that the rate of change in growth in the US started coming apart or falling apart ahead of the Liberation Day in early April.
Yeah.
Um, it wasn't too far after Liberation Day that you actually had to buy into equities again, which is very interesting. And I think there are two triggers for that in our nowcasting. The first thing you'll note is that growth sort of stabilized after, at least in the month after Liberation Day here, early April until May. So we had a stabilization there. And then on top of it, we actually saw the worst part of the whole liquidity situation play out ahead of the tariff scare in early April. And again, as we empirically pattern recognize what to trade in which regimes, the rate of change from a pro-cyclical, pro-growth environment to an environment that rolled over was a very strong signal for us to move out of cyclical stuff, out of risk assets into a Liberation Day. So, yeah, as you referred to, we were running a hedge fund through that quarter, managed to completely avoid the drawdown in risk assets. Helped a lot by this nowcasting technique. And we also slowly but surely started to onboard risk assets during April, May, and June when we started to see stabilization in the growth metric. So this was a very relevant exercise for us running money at the time. The other very interesting gauge right now, and also again a piece of anecdotal evidence, is obviously what has happened since early January. in the growth metric, right? I've added an arrow to the very bottom of this cyclical growth picture in our model. Through October, November, December, we actually did see some very choppy trends in equities, especially in the U.S. While we're now getting a fairly strong signal that the cycle is moving up in the U.S. The initial response in our model was to tell us, okay, this is long energy, this is long industrials, this is long consumer staples, actually, some of the sectors that have actually performed very well during the first couple of months. Now, with the recent uh, disinflationary trend towards February here, we've seen this flip of the regime into a quote unquote gung ho regime, which in turn has added over the past week or so technology back into the mix alongside some of the cyclical trades such as energy and industrials. So we have this very interesting mix right now where you should expect inflation to fall while you should expect growth to pick up. And that means you can buy technology and energy at the same time. A very odd mix, but you see that occasionally, right? And I think that's the exact cocktail we're currently amidst macro-wise. So again, it provided that very strong entry point for the cyclical rotation into very PMI sensitive trades and equity space. And now it's providing you with the view that inflation will drop alongside this cyclical pickup in growth, which is a new addition to the rotation that we saw in January and parts of February, which will probably end up being positive for some of the technology names that have been rotated out of through this year so far.
Yeah, yeah, and I also just wanted to point to the inflation curve here because
Mm,
when we saw that drop off in September, October, in the likelihood of inflation rising, that was a very contrarian signal because
mm,
most people expected tariff inflation to hit very hard towards Q4. It didn't. We're still having very benign inflation prints. So this was proven right, even though it was a quite contrarian signal. So maybe Andreas, we should put a few words also to some of the other geographies. Obviously, the US regime model is the core of this. It's the main driver also for the world regime model.
mm.
But we also run a separate regime model for the Eurozone here. And we're seeing quite some different developments compared to the US model, which makes for some interesting discussions and maybe talks about positioning. So what are we seeing in Europe and how do you gauge that right now?
Yeah, so let me add a few comments to what you said on how the US and the Eurozone impacts the world model that we have.
Mm.
It's maybe of relevance to the audience as well.
Yeah.
We we weigh these models with the market cap of each of these geographies. You could, of course, have argued to use GDP instead, but in my opinion, that would be wrong, given that the market is more allocated to the US than its GDP from a relative standpoint. And after all, what we're trying to do here is to use macro to trade, right? So we want it to be relevant for markets, not for the economy, so to speak. Having said that, the divergence between the US growth momentum and the European growth momentum is quite striking at the moment. And it's something that has developed fast over the past, say, 2 or 3 weeks, where we've seen a decline in the momentum, decline in the rate of change in Europe, and an increase in the rate of change in the US. And given that we've probably had the worst start to the year on record for US equity assets versus equity assets in Europe and Asia. This may be something to look into, right? Because at least this speaks in favor of adding a bit more to the US trade versus the rest of the world trade that has done so well for the past quarters, and which was, by the way, very well flagged in our models as well. On top of it, you don't see the same momentum towards declining prices in Europe. Or at least declining inflation. Declining prices would obviously be negative inflation. We're far from that, just to be clear. But in Europe, you should probably expect the inflation level to remain roughly constant at current levels. That's what our nowcasting tool suggests at the moment, meaning that the European Central Bank is probably very comfortable just leaning back and watching things as they go, while the current inflation sentiment in our US nowcasting suggests that the US central bank, the Fed, will be surprised on the dovish side on inflation. meaning that there's a scope for interest rates to go further down in the US, but not really in the Eurozone. That should also, of course, with the short time lag, underpin the duration case, the US asset case relative to the Eurozone. And interestingly, and that this is where nowcasting becomes a must-have tool. If you look at this divergence in cyclical growth in the Eurozone versus the US, where Europe is going down, the US is going up, the pattern recognition model has now flipped from being very negative on the dollar for a long while to being positive on the dollar. And I think it flipped 4 or 5 days ago. And, we've actually seen a very decent rebound in the dollar since that flip. And I think it is mostly driven by this divergence in cyclical growth, suggesting that the dollar could make a slight comeback here, which is, by the way, at the moment, incredibly contrarian to call for.
Very, very interesting, Andreas. Very, very interesting signals also to plan your positioning and portfolio. So once again, guys, please post your questions. We have one or two already coming in, so we will be getting to those in a minute, and we should have time for that. Let me just try and wrap up a little bit here before we get to some of the questions. So,
Mikkel, maybe allow me to expand a little bit on what we input into our macro drivers, right? Because I've talked about how we gauge inflation, but I can maybe put a few words on growth and liquidity as well.
Yeah, good idea.
So just to give you a glimpse of what we actually measure in growth and liquidity, to start with growth, we use on-ground hard data, no surveys, no questionnaires, nothing like that. We use hard measurable stuff. So for growth, we have 5 categories that we typically use across geographies. We have mobility and congestion. So we look at road traffic, we look at freight traffic, we look at ports, flights, etc., stuff like that. You can measure that every single hour, basically. We look at energy usage, so electricity, gas, and fuel consumption. You can measure that on a running basis as well. We use satellite data to look at pollution, night lights, industrial activity, stuff like that on a running basis. This is especially relevant for countries with less transparent access to some of the other categories, right? I've personally love the pollution metrics for India, China, and those countries because it gives you a very good gauge of the industrial activity in China, in India, for example. Then we look at tax receipts where they're available. So you can actually look at daily withheld taxes for payrolls. You can look at daily corporate tax activity relative to what is the typical seasonality. And then, of course, given that everything is getting more and more digitized, we also have, most transactions online now, right? So we can measure payments and card activity across the board as well. So, manufacturing heavy indicators are obviously freight data, ports data, satellite data, etc. And they explain the industrial output, while the service heavy sectors are mostly explained by the consumer spending patterns, the mobility patterns, etc., restaurant bookings, to give you one example as well. So, I mean, again, we're using hard data, no surveys. Surveys have, quote unquote, been terrible at predicting anything for years, especially in this very on and off cycle that we've seen since COVID. Lockdowns, reopenings, trade lockdowns, trade reopenings over the past year during Trump's reign. We've seen these on and off regimes, which makes it very, very important to track things live instead of using surveys. And on liquidity, let me just say a few words on that before we get to the questions as well. Maybe we get lots of questions coming in now. Liquidity is a very tricky category in many ways because liquidity's got many labels across many research outlets. What we're trying to measure here is the total amount of liquidity available for the economy. So we're both talking about narrow money and broad money measures. Narrow money measures look into the reserves available for banks to transact with each other, while broader money measures obviously look into the credit available for the broader economy. And the liquidity measure combines the two here. We're looking into allowing you to actually look beneath the hood in each of these categories for each of the geographies. It's a request that we've received a lot. But the important thing is here that we look at both narrow and wide liquidity. So we also track stuff like private credit on a running basis via credit proxies and issuance data, for example. So again, we have a daily read on the availability of money across the economy ahead of surveys, ahead of actual credit data.
That's very, very good to get in there, Andreas. Let me just wrap up a few news also on the platform. Then we're getting a lot of questions in. I was just a little bit faced by that, but let me just recap a little bit here before we get to the question sector. We've now shown you the core functions of NowcastIQ, the drivers, the regimes, the trade sentiment. What you also get in here as an institutional client is access to our articles and our macro portfolio. I can just briefly show that. This is a bit of an extra addition. The absolute core of this is obviously the data offering. We are opening a few more options to access our platform, since we are now in an even better place with our development of the platform, everything around the content. So we're opening up the option for a 7-day free trial. So if you're interested in trying this out for yourself, playing around with the indicators, seeing what's there, you can sign up for a free 7-day trial. If you are interested in just one license instead of an enterprise solution, we're also opening up that. We're opening up single seat licenses as well. So that will be an option. We know a lot of you guys have asked us for that. So we will be opening that up in the future as well. So hopefully that will be well received out there. So enough of that. Let me get to a few questions here. I'm gonna turn my head a little bit around here to see everything. So we have a question here coming in. What does gung ho, the current regime, mean for Mac 7, specifically Amazon? I've been crushed lately. Sorry to hear that. You're not alone in that, I believe. So maybe the best way to gauge that is to look at some of both the geographics of major equities. We have, let me find the. No, that wasn't what I was looking for. I was looking for the sectors here. Here we go.
Yes.
Sorry. To look at the information technology showing quite decent sentiment. It's not that strong a signal as compared to utilities and nuclear and energy. There might be some specific idiosyncratic points about the Mac 7, so I'll just allow you to answer briefly here, Andreas.
Yeah, but the short answer is that the signal for information technology overall, including obviously the Mac 7, has slowly but surely flipped in a positive direction, say over the past week or two. So we're getting there. I'm, personally also starting to lean into these trades slowly but surely. Haven't got any Mac 7 exposure as of now, just in full transparency. But we're getting there, and the regime tells you that the risk reward of entering these trades is improving relative to just a few weeks ago. So I think this is one of the odd regimes where you can actually be long energy and technology at the same time. So both inputs and digital outputs of that input, and I think we'll see that slowly but surely during February and March. But we'll obviously have to see how the pattern recognition model evolves. But it looks promising. Let me put it like that. For the Mac 7 specifically, we obviously need to get out of this AI fear mode. Most strategists and portfolio managers I speak to at the moment, they're very concerned about the current capex levels. I wrote a whole article that is available on the platform. You can probably also find it online because I laid bits and pieces from it out on X and LinkedIn as well, showcasing how the backlog of these hyperscalers, including Amazon to be specific, actually outpace the capex in nominal terms still, which is a very overlooked detail. The hyperscalers have a job to do right now. They need to convince all of these grumpy old men in the portfolio manager positions to look through the capex and the impact on the free cash flow, because that's obvious.
We have a question here from another listener. The charts are very intuitive. Very happy to hear that. That's what we were going for. So that's
Yeah.
very positive. However, how do we know when to pivot? Will there be some guidance from you? And that's a very good question. I didn't prepare this fully, so I'm hoping that this works on my access as well. I have a semi-admin access, so I'm not entirely sure, but it should come down here. Yeah, here we go. Under the settings, you can set up your name, your contact information, and you can set up email notifications. You can see I've turned it off. I'm not a very good follower here, so I'm not receiving the email notifications. I will just re-add that, and then you can decide what do you want to receive. You can either receive a notification every time we post an article, a daily update, general updates, commentary, or whenever there's a regime change. So if you pick the regime change, you will be notified when we see a regime, when the most likely regime shifts from one to another. Obviously, as a trader, you might want to get in a little bit ahead of this and check the data more frequently. But if you just want a reminder that now we think there's a regime change, which is the absolute most critical time to look at these data, then you have the notification right there. One thing I like to check out every day, I go to the platform, I don't receive it by email, I will now, is the daily data update here. And if I just go to the back to the dashboard here, what you have in the top here is a feature I actually like very much. It's a short AI generated summary of both our data and the most recent research from Andreas. So this gives you a few very brief talking points. So if you're heading into a macro meeting, you're heading into your boss is asking you, oh, what's going on in your screens right now? Here you go. Here's 5 talking points to throw into that meeting if you didn't have time to prepare for it. So that's a function I hope a lot of you guys in institutions might find very interesting. Just make sure that no one else in your institution uses it at the same time. That might become a little bit awkward. But this is how you set up notifications of when to pivot and when to gauge these changes in the macro regime.
On top of that, Mikkel,
Yeah.
we do alert via email daily. We
Yes.
call it the something for your espresso. It is
Yes.
a morning comment most frequently where we refer to the most important changes that we see in our data, basically. And we often refer to the trade sentiment, obviously, if there is something very valuable in there. So that is also a part of the single seat subscription, that you get these daily comments from our team on what to look out for in the data.
For the next question, I'm just going to sign out. Hope this works. Because we had a question coming in here on how to sign up for the 7-day trial. If you head over to nowcastiq.com, you may need to sign out if you want a trial. You're probably not a user, so forget that. You should see the button of start your free trial. Then you'll have to sign up, and you will get in there, add your company details, and you will get instant access essentially to the free trial. So no credit card needed for that. That's only applicable when your trial is up. So that's for that question. Another question here on the equity sectors that we were looking at before. I can understand why tech would be attractive given your macro view, but why is utilities preferred? That should generally be a defensive sector, which on an acceleration of growth shouldn't really be the place you generally want to go. Do you have any ideas, Andreas? Because I mean, the reason why it's flagged here is because our pattern recognition shows you that. So that's the quick answer. But do you have any thoughts on the utility sector here, Andreas?
So a couple of things. Our bond signal has also flipped positive for the first time in a long while. So if you look at the fixed income
Yeah.
signal, it's basically positive across the board, across geographies. Not as strong a signal, but it's positive. I think it has to do with the inflation outlook. We're talking about inflation that is coming down faster than what is priced in. Should be mostly benign news for bonds. On top of that, the utility bet has turned into some kind of an AI bet, an AI input bet, right? Because we know that most of the hyperscalers are looking into solutions that are to some extent decentralized, but also on how to secure grid access in a decently benign way from a return on investment perspective. If you look at the grid expansion in China versus what we've seen in the US and in the Eurozone, you probably get a glimpse of what is ahead of us, right? We need to expand the grid fast and at yeah, 5 to 10% a year probably, if this current data center expansion continues, and utilities will obviously play an important role in that whole build out. So I typically put the AI trade into three categories: AI hardware, AI electricity access, and AI software. Software is the one that's doing the worst. AI electricity is doing the best of the three right now, and AI hardware is sort of sidelining itself at the moment. AI electricity has been one of the most stable trades for, say, 3 or 4 months running, and it's still flagged as a super trade in the trade sentiment score.
Absolutely. Let's have a few questions here. We have two questions on API capabilities, and that is something that's very, very high up on our wish list. It's something that we would love to speak to some of you quants or PMs about, because we would like some more information on exactly how you would want that to work. So I think it shouldn't be too far into the future. We're very, very eager to find some design partners on that. So if you're interested in having a small chat with our tech team, please do reach out to us, because we're very eager to create a solution that works as seamless as possible to you with regards to what data you need and how the flow should be. So not right now, but hopefully very, very soon if the interest is there. We had a question on the portfolio and the updates on it. So just to quickly show that, we're running a macro model portfolio. It's using single stock names. We have a decent enough return this year. It was a lot better than last year, but that goes from most tech stocks. This is not a tech portfolio, but it is relatively tech heavy. It's divided into various thematics that we really, really like for 2026. And you can read the entire rationale for our dividing into thematics. We release every Friday a portfolio update called What We Told Hedge Funds, and this is where you find our takes on the current portfolio setup, what we've added, what we've taken out. And this is our single stock portfolio. It's essentially that is fundamentally driving on or built on the macro regime. So we might have stocks in here who are not flagged as top performers in the current macro regime. That's how you usually put together a portfolio. You don't flip it around every time you have a shift, but that's obviously a very big part of our decision making in this portfolio as well. So that is also part of the institutional package here. A question here from another listener. Hi, Mikkel and Andreas. On the US dashboard, let's go over to this. In the sector equity section, let me go down here. Here we go. Are the sectors listed fixed beyond the standard GICS classification, or do you add and remove sectors based on the expected performance under the current macro regime? So if I understand the question correctly, no, these are the same sectors no matter what the regime is. So if we flip to lame.qe, it's going to be the same sectors with their corresponding sentiment and score on this. So it is the same sectors that we're scanning for backwards. We are ongoing looking to add or change to this, but we believe this is a good set of major sectors that most people are looking for. But please do suggest if you have something you feel is missing in here.
Yeah, and the short answer to that question is that if you think that something is missing here, we can add it in a day. So
yeah, very good point. If you're a paying user, that is. No. A few questions on the subscription fee per month and per year. So first and foremost, this is an institutional product. That's how you get full access. As I said, we are also building single seat licenses. The pricing there will be $299 per month. There will also be a yearly price with a bit of a discount. I believe it will come in at $3,000. So that's going to be the pricing for single seats. There's obviously the opportunity to get your whole enterprise in there and pay by invoice as part of an institutional offering that will then have full access. So that's up to you. But we are opening the single seat license. My suggestion would be to start out with a free trial, see if you like it, and then get in touch with our team on whichever setup works for you along the way. And again, once you're inside the trial, please give us all the feedback that you can. We're very, very eager if something isn't quite what you expected or isn't quite working to your needs. We're very, very eager to build towards that, because this is still a platform that we are trying to build on and improve as we go. I think that pretty much got around most of the questions. So, Andreas, do you have any final remarks here? I think we covered the platform relatively decently. People will have to try it for themselves, obviously. Do you have any final remarks or thoughts before we close off for today, Andreas?
No, I think the interesting setup right now is that cyclical growth is improving fast in the US. It seems very underappreciated by markets. And it happens at the same time as inflation will likely surprise on the low side of expectations, say, over the coming 2 or 3 months as well. That is a pretty textbook Goldilocks environment. Let's see how markets play out, but I'm getting increasingly upbeat myself.
And that is not what you hear in from most sources at the moment, neither on Twitter or in the more established financial news. So let's see. Hopefully we're right. If we are precisely right in a few weeks' time, we hope you will remember where you heard this the first. So anyways, guys, that was all that we had for you today. We would like to thank all of you very, very much for joining. Thanks to you, Andreas, for joining in. Thanks to our great team behind NowcastIQ. If you like what you saw, sign up for a free trial. Get in touch with our team with your thoughts and ideas. And we will hopefully be in touch along the way as we build NowcastIQ for you. Thank you, guys, and see you out there.